Fixed income is another word for the bond market. And while the bond market may appear arcane, it plays the crucial role of setting the price of borrowing and lending to governments, businesses, and consumers. The interplay between bond prices, bond yields, inflation, and creditworthiness are foundational to the setting of interest rates. In this module, we will cover 5 topics: how the bond market came into being, key factors that drive bond prices, the role of central bankers in setting interest rates, an overview of the yield curve, and how and why the yield curve moves. In the process, you will discover how the bond market became the biggest, most complex market in the world and how it serves a vital public service. Describe how yields facilitate comparisons across the vast diversity of the bond market. Explore how government bond yields are yardsticks by which all other investments are measured. Examine how the bond market instills discipline in governments. Discover why, when, and how central banks make interest rate decisions. Explore how bond valuation is driven by creditworthiness, inflation, and central bank interest rates. Describe the importance of the yield curve to all governments, businesses, and consumers, and interpret the meaning of the 4 major shifts in the yield curve.
Fixed income is a fancy term for borrowing and lending. Bonds are effectively tradable IOU notes. The fixed income market is the biggest market in the world. At the end of 2016, there were over $101 trillion worth of traded bonds in existence worldwide. This is bigger even than world GDP, which, as we saw earlier, was $79 trillion. It also towers over the world stock markets. Here we can see that the world stock markets were worth. If we look at Bloomberg's Encyclopedia of Bonds, the Fixed Income Search Function, or SRCH, we can see that at the end of 2016, there were 2.1 million government and corporate bonds in existence worldwide. If we bring up a list of those 2.1 million bonds and add up the total market values, we can calculate that the world bond market was worth $101 trillion. Let's focus on U.S. government debt. In total, the U.S. Treasury had 1,086 actively traded bonds and bills outstanding, accounting for $14 trillion of the world bond market. This is the biggest single chunk. As we will see time and again, the U.S. government bond market plays an important role in global finance. Now let's filter the global total of 2.1 million bonds to focus on the corporate bond segment, and then further filter this down to show only U.S. corporate bonds. The U.S. dollar-denominated corporate bond market is the second largest segment with $8 trillion of bonds outstanding. The fact that the United States, therefore, hosts a fifth of the world bond market is one of the main reasons for the dollar centricity of the currency market. Despite its size, the bond market is, like the FX market, a relatively recent phenomenon. It was born out of interest rate liberalization and the removal of capital controls after the Second World War, which made it easier for governments to borrow. The biggest segment of the world bond market is the government bond market, also known as the sovereign debt market. Governments historically used to raise money for only a few outlays, such as spending on war and justice. For example, the Bank of England was founded in 1694 to finance the Royal Navy. With the advent of the welfare state and social safety net, government spending as a proportion of GDP has risen steeply as advanced nations now pay more for health care, education, and other public services. U.S. government spending as a proportion of GDP has more than tripled from 13% in the early 20th century to over 40% a century later. Meanwhile, over in Europe, government spending as a proportion of GDP is even higher. For example, it accounts for more than half of Danish GDP. Let's plot the U.S. government tax receipts and their outlays on a chart with the budget function, BUDG. The orange line represents outlays while the white line represents tax receipts. When the orange line is above the white line, the government is spending beyond its means and needs to borrow to fill the gap. This is known as a budget deficit. While this may sound unsustainable, France has run a deficit every year since 1972. From the 1940s to the 1970s, U.S. government taxation and spending used to be fairly in sync. The last time the U.S. ran a meaningful surplus was during the Clinton years, when the U.S. benefited from the post-Cold War peace dividend and high tax receipts from the dot-com boom. In the wake of the 2008 financial crisis, the U.S. government ran the largest absolute deficit of any country in history as it shored up the financial system. If we type Treasury securities into the command line, we can call up the total amount of U.S. government debt, according to the Federal Reserve. Over the years, the rise in U.S. government debt began to enter the public psyche. By 1989, U.S. national debt stood at $2 trillion. This prompted a U.S. real estate developer to install the U.S. National Debt Clock near Times Square in Manhattan. The clock started to count down, not up, in 2000 during the Clinton surplus years. As it was designed to highlight rising debt as opposed to falling debt, it was unplugged and covered with a red, white, and blue curtain. When debt started rising again in 2002, the curtain was raised and the clock switched back on. On September 15, 2008, investment bank Lehman Brothers went under, triggering the financial crisis. 2 weeks later, on September 30, 2008, the debt clock ran out of digits when the debt broke through $10 trillion, and they had to build a new one. But who lent Uncle Sam several trillion dollars, and why? We can see the owners of U.S. government debt securities by typing sovereign debt ownership into the command line and selecting the debt DEBT function. Let's go to the Foreign Holders tab at the top and click on the Pie Chart button. This displays a pie chart of the non-U.S. owners of U.S. government bonds. We can see that of the $14 trillion of actively traded U.S. government debt, $6 trillion was owned by non-U.S. entities, meaning that U.S. entities own $8 trillion. Japan and China own approximately $1 trillion each at the end of 2016. So now we know who owns the U.S. government bonds. Why do they own such a large quantity of them? Two of the reasons lie in the world of currencies. Since currencies floated freely since 1971, many countries have been forced to accumulate war chests of FX reserves to defend their pegs or to scare off speculators. Meanwhile, other countries have sold their own currencies to buy U.S. government bonds in order to weaken their currency. Those countries that need FX reserves use U.S. Treasuries as a safe and easily accessible place to park their money. U.S. government bonds are widely viewed as the safest financial asset on earth. The U.S. has this strong reputation for creditworthiness as it has the right to tax the citizens and businesses of the wealthiest country on earth. In addition, the U.S. has the so-called exorbitant privilege of being able to print the world's reserve currency. The U.S. could ultimately pay everybody back by either increasing taxes or simply printing its widely trusted cash. U.S. government bonds are the most liquid tradable assets on earth and are naturally U.S. dollar denominated. Conveniently, the FX market is also U.S. dollar-centric. This makes U.S. government bonds the proverbial piggy bank for the world. We can demonstrate the use of U.S. government bonds as FX reserves by demonstrating the correlation between the total amount of world FX reserves on the right-hand y-axis and foreign ownership of U.S. debt on the left-hand y-axis. The boom in FX reserves from 2002 to 2014 was mirrored by a boom in foreign ownership of U.S. government debt. So now we know the reasons for the rapid growth in the U.S. government bond market. The U.S. is running a large deficit, and non-U.S. governments are looking for somewhere safe to park their FX reserves. Not only do governments around the world use U.S. government bonds as a safe place to park FX reserves, investors also use U.S. government bonds as a safe haven during times of turmoil. The commonly accepted indicator of market turmoil is the VIX Volatility Index, otherwise known as the world's fear gauge. When the VIX is high, investors are scared. When low, complacent. Bond prices move inversely to bond yields, a relationship we'll explain a little later. When fears spiked on 5 separate occasions in a given 25-year period, investors bought U.S. government bonds, thereby pushing yields down. This happened during the Russian debt default crisis of 1998, the dot-com bust of 2002, the Great Crash of 2008, and the Greek crisis of 2010. In the summer of 2011, political brinksmanship in Washington, D.C. resulted in U.S. government debt being downgraded, with the U.S. losing its prized AAA debt rating. This caused market turmoil, with VIX spiking and U.S. government bond yields plunging. Of the 2.1 million tradable bonds in the world we saw earlier, corporates is the other major segment and is again a recent phenomenon. In 1980, only a few hundred U.S. corporations had access to the bond market. If we exclude government bonds from our bond search, we see that 1.6 million of the 2.1 million bonds outstanding are corporate bonds. Given that there are far more large companies in the world than there are governments, there is a greater diversity of corporate bonds than government bonds. As with the U.S. government, a single government with 1,086 outstanding bonds, some companies also issue a vast array of bonds. Take IBM. We can load the company by typing IBM into the command line and selecting the security. By clicking on Company Overview and choosing CAST, we can pull up its capital structure. This displays the parent company and all its subsidiaries, such as businesses in Argentina and France. The bar chart at the bottom shows how the financing of the parent company breaks down between shareholders and lenders. If we click on the Security Detail tab and drill in to see a list of the bonds, we can see that IBM has a number of outstanding bonds. Why do companies borrow in the corporate bond market? 2 reasons. First, in almost all countries, a discrepancy in tax treatment means that debt repayments lower a company's tax bill by reducing pre-tax profits through interest payments. As there is a corporation tax on company profits of over 20% in many advanced economies, being financed with debt saves a company money. Second, companies can borrow money for longer terms from the bond market than from banks, which are not typically keen on making long-term loans to corporations. Now that you know why the bond market exists and who the main borrowers are, let's zoom in and look at how an individual bond works. It is effectively an IOU note which promises to make regular fixed-amount payments called coupons, and a large payment at the end of the loan called the principal. To visualize bond payments, let's pull up the country Rwanda, view its bonds, select one, and then type debt distribution into the command line to select the DDIS function. In mid-2013, Rwanda joined the government debt club by issuing its first bond, borrowing $400 million. Here we see the repayments due on Rwanda's maiden bond. The bar chart depicts the chronological repayments. The rigidity of this repayment schedule gives rise to the term fixed income for this form of borrowing and lending. Rwanda is set to pay back $27 million of coupons per year and $400 million of principal in 2023. The reason why the repayment is only $13.5 million in 2013 is that the bond was issued halfway through that year. Similarly, as it is a 10-year bond that expires in mid-2023, there is a $13.5 million interest payment in this final year in addition to the full principal repayment. This means that the bondholders who lent the money at the outset would be repaid $670 million over the following 10 years as compensation for lending the original $400 million back in 2013. So we know how much Rwanda borrowed back in 2013 and all the subsequent repayments. We will talk in more detail a little later about how bond yields are calculated. In brief, for now, it is the same approach a credit card company uses to calculate the annual percentage rates, or APR. In the case of this Rwandan bond, an APR calculation would give us a 7% effective annual interest rate on this loan. Rwandan bonds, however, are bought and sold for whatever price people agree to trade them at. The bond price therefore fluctuates, which is the main input to the APR calculation. Therefore, the APR for future owners of the bond changes depending on the price they paid for the bond. Newcomers to finance often get confused and think that fixed income means fixed APR or that the prices of bonds are fixed. It does not. Fixed income only means fixed repayment amounts, and even then only provided the borrower actually pays you back. The latest calculation of the APR is called the yield. The main input to the yield is the price of the bond, and this fluctuates. The other input is whatever bond repayments are yet to happen in the future. Over time, as the bond gets repaid, the amount of remaining repayments decreases. These remaining repayments, along with the floating price of the bond, are used together to calculate the yield. We will use the term yield throughout the module. The magical thing about yields is that they make the kaleidoscopic diversity of the world's 2.1 million bonds comparable. Generally speaking, the lower the agreed purchase price for a bond, the greater the APR, or yield, as a smaller upfront sum results in the same fixed amount repayments down the road. When the price of a bond goes down, the APR, or the yield, goes up, and when the price of a bond goes up, the APR, or yield, goes down. Let's leave the playground behind and show this inverse relationship in the real world. The best way to show this relationship is by graphing the price and yield of a special type of instrument called a perpetual bond. For these bonds, for which the principal is never repaid, the price and yield are a perfect mirror image. Who are the winners and losers when yields change? When yields or interest rates are high, prospective lenders are happy as they get relatively more repayments for their planned loans. Prospective borrowers, meanwhile, are unhappy as they would have to promise to pay back relatively more to secure a loan, and vice versa. Think you've grasped these concepts? Answer these questions to check your understanding. To summarize, fixed income or the bond market are fancy words for the trading of loan agreements. Fixed income is called fixed income because the borrower promises to pay fixed, pre-agreed repayments at future dates. The increased spending of governments over the last century is the main growth driver of the largest market in the world. U.S. government bonds are the basic building blocks of the financial markets because they are safe and liquid. Fundamentally, investors care about the income that bonds provide, and thus bonds of all shapes and sizes are compared using their yields. Yields facilitate bond valuation. Let's begin by explaining how they are calculated and why they move. First, how are bond yields calculated? Let's think in terms of a pot of gold at the end of a rainbow. Imagine that your Aunt Mary gives you $80 for your 15th birthday. You want to save this money to buy a bike in 3 years' time. Your sister just turned driving age and would like to buy a used car. She is asking her family for loans. If you lend your sister the $80, she promises to give you $90 back spread over time, $10 back next year, $10 back the year after, then $70 back in 3 years' time when she plans to get a job. Your mother would rather you deposit your $80 gift in Ledyard Bank to earn interest. Ledyard Bank is offering 4.53% per year interest. Which option makes you richer in 3 years? Which option leads to the bigger pot of gold at the end of the rainbow? How big would the pot be if you deposited the $80 in Ledyard at a 4.53% interest rate for 3 years? Let's visualize the money changing hands if you were to deposit the money at Ledyard. To begin with, you hand over $80 to the bank. Let's depict that as negative $80. At the end of year 1, you would get $3.60 in interest, 4.53% of the $80 balance. That would make your balance $83.60. At the end of year 2, you would get 4.53% interest on the $83.60 balance, meaning $3.80 interest in year 2. This $3.80 payment consists of 4.53% interest on the original balance, plus 4.53% interest on the previous $3.60 interest payment. Earning interest on interest payments is known as compound interest. The balance would now be $87.40. At the end of year 3, you would get 4.53% on the $87.40 balance, meaning $4 of interest in year 3. You then withdraw your deposit and the accumulated interest of $3.60, $3.80, and $4. So if you had put the money in Ledyard, you would end up with $91.40. How big would the pot be if you lent to your sister? You hand your sister $80. In the end of year 1, your sister hands you $10. At the end of year 2, she hands you another $10. At the end of year 3, she settles the loan and hands you $70. Assume you deposit both $10 bills in Ledyard Bank. Let's treat each in turn as a separate deposit to grow at Ledyard. Let's take the first $10 payment. At the end of year 2, this would grow to a rounded $10.50 in the bank. And at the end of year 3, it would grow to approximately $10.90. Let's take the second $10 payment. At the end of year 3, this repayment would become a rounded $10.50. Recall that your sister also hands you $70 at the end of year 3. You've got no time for this to accumulate interest in Ledyard Bank. So how much did you end up with by lending $80 to your sister? $10.90 plus $10.50 plus $70 for a total pot of gold of $91.40. So provided you think your sister will repay you in full, and provided Ledyard will still be around when it comes time to withdraw the money, this pot of gold will be the same size as that pot of gold. You forked out the same $80 and in roundabout ways ultimately got to $91.40 in both scenarios. You are therefore entirely indifferent between lending to your sister on the agreed terms and depositing $80 in Ledyard for 4.53% interest. In fixed income terminology, the yield on the loan to your sister is 4.53%. That's all a bond yield is, the equivalent interest rate on a bank account that would provide an identical pot of gold at the end of the rainbow. But how did we know that 4.53% would make you indifferent between lending to your sister and depositing it in the bank? One way is guesswork. Let's demonstrate. You've grown up and left home. You win the lottery and take home $1 million after taxes. Your brother now comes to you asking for a loan to buy a boat. He is looking for $1 million and agrees to pay you back $100,000 next year, $100,000 the year after, then $1,100,000 in 3 years' time when he will come into an inheritance. It's the weekend, and Ledyard Bank is closed, so you don't know the interest rate to help you decide whether or not to lend your brother the money. But he doesn't know the first thing about fixed income, so he's pressing you for an answer. Which option should you go for? Let's just see what deposit rate would make your pots of gold at the end of the 3 years the same size, regardless of whether you deposited or lent the $1 million. If on Monday morning you discover that the bank is offering above this rate, you should bank it. Below, and you should lend to your brother. Let's suppose the bank were paying 5%. Using the same methodology from the previous example where you deposited $80 at 4.53% interest, you're now going to deposit $1 million at 5% interest. You would end up with $1,157,625. What if you lent to your brother with this bank deposit rate of 5% for the interim repayments? Let's deposit the interim payments in Ledyard Bank at 5% interest, treating each in turn as a separate deposit. You would end up with $1,315,250. Assuming you trust your brother and the bank equally, you should lend the money to your brother if Ledyard offers only a 5% interest rate, as you will end up with a bigger pot of gold than the bank would give you. We therefore have not correctly guessed the yield on the loan to your brother. Let's try a higher guess. What if the bank paid 15% interest? In this case, you would end up with $1,520,875. What if you lent to your brother with this elevated bank deposit rate of 15% for the interim repayments? As before, let's deposit the interim payments at Ledyard Bank, but this time at 15% interest. You would end up with $1,347,250. Assuming you trust your brother and the bank equally, you should deposit the money at Ledyard if the bank offers a 15% rate, as you will end up with a bigger pot of gold than if you lend to your brother. We now appear to have overshot in our guess of the yield on the loan to your brother. Our 5% guess was too low, and our 15% guess was too high. Let's make our next guess 10%. If the bank paid 10% interest and you deposited the money, you would end up with $1,331,000. What if you lent to your brother with this 10% bank deposit rate for the interim repayments? As before, let's deposit the interim payments in Ledyard Bank, but this time at 10% interest. You would end up with $1,331,000. Success! You would get the same size pot of gold from depositing it at Ledyard's at 10% as you would from lending to your brother. So now you know the precise deposit rate at Ledyard's above which you would park your money at the bank and below which you would instead choose to lend to your brother. So what's the takeaway? Well, if you have the loan terms and enough time on your hands, you can guess your way to a bond yield. You'll be pleased to hear that there's a shortcut to extracting the yield on a bond from the bond terms, either using the internal rate of return function on a spreadsheet or simply looking at the Bloomberg yield and spread function, YAS, and reading off the pre-calculated yield. Let's demonstrate the YAS shortcut using the Rwanda example. Rwanda borrowed $400 million in May 2013 and agreed to pay back $27 million per year. Given that the 10-year bond was issued halfway through 2013, there were smaller $13.5 million interest payments in both the first and final year. The $400 million principal amount is due to be paid back in 2023. When the bond was sold to the public in May 2013, it had a yield of 7%. Let's visualize why an investor would be indifferent between putting $400 million into a bank paying 7% per year until 2023 and lending to Rwanda on these terms.